BBC TV 18 exclusive. As part of our special series, What the World Wants, I caught up with Bill Maldonado, the Chief Investment Officer, Asia Pacific and Global CIO of Equities at HSBC Global Asset Management. Bill manages over $100 billion in assets in various countries around the world. I began by asking him what his view on the world economy was, considering there is a fair bit of uncertainty surrounding the policies of the Trump administration. Take a listen.
Well, certainly investors around the world are very concerned about uncertainty. Actually, when you look back at, say, imagine that you teleported back to 2005. Look at all the horrendous things that have happened since 2005, from nuclear missiles in Korea, the global financial crisis, ISIS rising, terrorist attacks all over the world. It's been a horrible, horrible 12 years. And yet the US equity market has doubled over that time. So in general, investors get far too focused on events and negativity and don't focus enough on fundamentals. And I would say right now, the fundamentals are very interesting and I would even say very positive. Something quite large, quite big has happened this year. And I don't mean Trump, and I don't mean Brexit, and I don't mean all those other things. They're related, but they're not the main event. The main event is that we've got an end of austerity situation. I think it's too early to call it reflation, but we've certainly got an end to the very austere kind of policy that's been pursued by most governments around the world. That's been a big fiscal drag on the economy, which has had to be made up by monetary policy. That's been doing the heavy lifting around the world. And this year, for the first time in a long time, we have the prospect of fiscal policy coming into play on top of an already strengthening economy. So that's a very positive outlook for investors, very positive outlook for equities and risk assets around the world. Of course, there are risks attached. We have the rhetoric that comes with that around protectionism and deglobalization. We hope and we believe that that is more rhetoric than real intent, but we have to wait and see. For now, the judgment is that the positives will very much outweigh the negatives, and that this stronger economy will be good news for investors, particularly in emerging markets, which are very exposed, dare I say, geared to the global economy. Less so than a decade ago, maybe, because we now have a consumer class that's emerged in most developing economies.
Right.
But still very much more exposed to the world economy than other markets.
So end of austerity is how you're calling it, and that's, we can see that traces of it around the world in big economies and smaller economies as well. Very briefly, Bill, austerity did not mean that stock markets around the world did poorly. I mean, the US market has done very well. People have been trying to call the top off it for a while now, unsuccessfully.
Correct.
So when austerity is behind and the fiscal policy takes
Correct.
a driver's seat, what does it really mean?
So austerity, you're right, has not necessarily held back markets completely, but it's certainly been a drag on growth. And as far as growth feeds into earnings and earnings drive stock markets, it's been a drag on stock markets as well. So despite good performance, we perhaps could have had even better performance, even better growth. So we don't think that equities are overvalued. At best, the US is neutral, or at worst, depending on your perspective. And other markets are significantly cheaper. So we might prefer the world ex-US, but the US still looks okay. So I think there's a lot of upside in these markets, especially if investors begin to see the growth coming through in earnings. That's really the key for the next year or 2 years. And if that happens, we could have quite strong markets.
You don't believe that the US is turning inwards? There is a fair bit of commentary going all around that, well, that is what is happening. Border taxation and things like that. You don't think that will be a reality, or you believe that even if that were to happen, it will not impact globalization, so to speak, to that degree?
I think if it happens in a very strict way or in a very aggressive way, of course that could be very harmful to the world economy and therefore to asset prices. It's at the moment not our central expectation that will be enacted in that way, for the simple reason that the administration in the US and anywhere else that wants to be very protectionist and anti-globalization will hurt its own support base very badly if it executes too aggressively. If you think about Trump's support base, it comes from middle class, lower middle class, blue collar workers. They will shop at a Walmart, at a Target, at places which are very dependent on imports to be able to provide good, very low prices and wide choice of goods to consumers. If we start seeing those prices rising as a result of trade barriers, tariffs, etc., then that would hurt those consumers. That would hurt the support base of these populist governments. So there is a break, there is a cap on how aggressive they can get. Now, that's a view at the moment. We don't know that. Nobody knows that for sure, how that's going to play out. But at least we can observe that there is a cap to how much they can do. And so our judgment is based on that analysis and saying, therefore, the upside is a lot more than the downside from what we can see at the moment, but we have to continue to monitor that risk.
You said you prefer world stock markets ex-US. You're okay with US as well, but if you had to kind of sort of stack it up, you'd prefer markets outside the US. Which are your top bets right now? And does India figure in the top 5, say?
Okay, so we would start at a regional level, and we would say Europe looks more attractive than the US amongst developed markets. Japan hedged looks very attractive amongst developed markets. And then emerging markets look very good versus developed, particularly Asia. So those would be our preferences. Within Asia, and we would include, of course, India in our Asia definition, we would say North Asian markets, China, Korea, Taiwan, Hong Kong, look the most attractive, simply because investors were trying very hard to get away from those markets when they were very worried about China. They're much less concerned about China now. And so what they did was push down prices and valuations there, and they pushed up valuations in the ASEAN countries. India is very interesting. India is somewhere between those two. And India hardly ever gets cheap relative to the rest of the region. India is usually an expensive market, and right now it's a neutral market. So within India, we can find interesting opportunities, and India looks relatively attractive compared to its own history. So we like India, and we have exposure to the Indian market in the global portfolio.
We have the union budget, which is always a big event here. Bill, what's your sense? What should be done by the government, by policymakers, to attract more capital? I mean, both finance capital and FDI.
Well, I think the government has so far got, I would describe as a fantastic track record. If I think about the reformist agenda, that's one of the big attractions in emerging markets, right? There's a lot of gains to be made from reform. And if I am interested in buying markets where I see a lot of reform, where we see a lot of reform, India is right up there. It's probably the most reform-driven market of the last 3 years. So I think to start, we have to give the government a lot of credit for what it's already achieved. In terms of specifics for the budget, I don't really know. I don't know what to expect. These things are usually very unpredictable. I would say that one benefit that the Indian economy has right now is the perception that international investors have, which is that not only is the government reform-minded and is prepared to tackle really quite challenging issues, but it's also running a very fiscally prudent and monetarily prudent economy. So we've got a well-run RBI. People were perhaps a bit concerned in the transition from the previous governor, but that seems to have gone extremely well. And the new governor's established his credentials. And I think from an international perspective, what investors would be saying is, please don't do anything to damage the credibility and the goodwill that you've built up internationally over the last 3 years. And we don't think they will. We think they'll continue to be very prudent and very disciplined and continue to build on that goodwill.
So you're saying that you hope, expect, and you think the government will stick to its fiscal deficit targets. They won't loosen it. They won't engage in deficit spending. That is essentially what you're saying. On taxation, there is a lot of talk now this time that taxes on stocks, the threshold to avail of those exemptions might be made tougher. Right now, if you hold stocks for over a year, you don't have to pay the 15% tax. That might be made 3 years. The rate of taxation might itself be bumped up from 15 to 20%. How might investors view that if it were to happen?
I don't think that would be a huge negative. That would align equities with sort of other asset classes. And I don't think that would be a big negative. That's actually a benefit that India has, that it rewards long-term investors, long-term holders of equities. So I wouldn't personally see that as a big negative. I wouldn't necessarily try to predict that either. I wouldn't forecast it, but if it occurred, I wouldn't see it as a big negative. Jumping back for a second on your fiscal question, just to add a little bit of color to that, what we would say is, look, the government here has done a great job of using the fall in oil prices very, very wisely. In other places, in other countries, what we've seen is the dividend, if you like, from lower oil prices get squandered. Here it has not been squandered. It's been used wisely. We've seen the government's fiscal picture improve. We've seen it repair its balance sheet, as it were, and we've seen it reduce subsidies and do other things that, in our view, are very, very smart, very prudent, very wise. So it's left itself in a position which is very solid. So if you say to an international investor, what do you think are the challenges that the government has in meeting its fiscal targets? I think most international investors would say, the government should relatively easily be able to meet the fiscal targets that it set out. Of course, there can be variation plus or minus when nobody's trying to hold the government down to 3 decimal places on a budget target. But they have built themselves some room to maneuver. They should be able to hit those targets relatively comfortably.
Bill, just one last very quick question. Corporate tax rates being brought down. Mr. Trump is talking about in the US, big change there, lower. Does it need to get done here? And how urgently?
That's always good news for investors. Investors are going to like that very much if we see a move in that direction. I think the challenge for India is slightly different. It's a very different stage of development to the US economy. So that may not necessarily be a government priority, and perhaps it shouldn't be a government priority, although investors would like it. Much more important, I would say, is for the government to widen the tax net, to bring into more formal employment a much wider set of the population. At the moment, it's a very narrow range of the population that's in formal employment and paying taxes. So broadening that perhaps is a higher priority for the government than corporate taxes. But I don't know. I think investors will welcome that kind of move also.